We have a critically important video for you today. We're going to start this off with what Fundstrat's Mark Newton just said about our markets. He's pretty bullish, as Fundstrat normally is, but he does acknowledge the weakness we're seeing in the economy. He does speak about 10-year, 20, 30-year treasury yields, the entire yield curve that is likely to start falling, which could be positive for equities as well. We'll also discuss here in this video your major economic data coming out this week. We have a speech from Powell, we have CPI, we have PPI, we have retail sales, initial jobless claims, all kinds of different things. But we also have some big earnings, one of which is Walmart. I believe Walmart is the smoking gun, if you will, for the state of the consumer. It was back on August 14th of 2007. Walmart warned about the consumer that was getting their paychecks eaten away by energy prices and by economic pressures. If Walmart has a similar warning for investors coming this week, that's going to be a big eye-opener for the markets. But let's go ahead and start with Fundstrat and what they just said about stocks on Friday.
Longest winning streak since December and is now approaching. Dow's on its longest winning streak since December and is now approaching 40,000. Let's take a closer look now at the charts. Joining us is Mark Newton, Fundstrat Global Head of Technical Strategy. What, you get a couple of jobs reports, I guess, a claims number that goes up. And our cuts, is that what's causing, is that what's doing? I know it's technical. You're not really a fundamental guy, but the attitude kind of changed back again, didn't it, to a possible cutting scenario?
I think that's right, Joe. Look, I think the narrative has changed to some extent. We do see that bad news is good news for the stock market. Anything that causes rates to start to pull back a little bit and or the U.S. dollar is seen as very good for risk assets. And so we did see jobless claims hit the highest level since last August. We saw a really poor ISM number and also a lower jobs number last time. And the combination of those caused treasuries to finally start to rally. I think that's honestly a very good sign at a time when people were worried that rates were going up above 5% on the 10-year, that inflation was here to stay. So, the real key, I think, from an economic standpoint will be CPI, to really see if there's some evidence that that can start to pull back. Technically the market's in very good shape here. Breadth is, largely, we see about, over 70% of the stocks above their 200-day moving averages. That's a very good sign. And it hasn't been technology. That's what's been interesting. We've seen other sectors start to participate, and you see financials, industrials, materials, even utilities, which is largely an AI-driven theme as to why that sector is moving. But it's gotten to be a lot more broad-based, and so that gives me some comfort that this actually can continue, and we are sort of in a sweet spot at the time when, the economy is chugging along, and there are a few signs that it might be starting to pull back and tail off a little bit, but I don't think it's that dramatic.
Is there any reason to think that that growth or a slowdown in labor, in what we see on the first Friday of every month, will that definitely translate into to cooler inflation numbers? It's not, doesn't mean it has to be that way, does it?
Yeah, look, I think it's always very difficult to take economic data and try to, pinpoint exactly what the market's going to do. I would say the labor market is we're seeing evidence of the starting of some cooling. We certainly don't see rapid unemployment, and I think the market knows that, and that's certainly a good thing. But the recent data has confirmed, I think, Powell's dovishness, and I think the market still is on pretty good footing. I mean, technically, we're in, as I said, very good shape. You just have to look at the sector rotation and what's happening. And technology, even though it's pulled back a little bit, has not really, we're not seeing a massive decline in most tech. It's stabilized, and stocks like Apple have begun to start to break out, and that's a very important piece for the S&P and for QQQ.
So how's the sentiment, bullishness, bearishness, and as far as election years, we're up, I think, 9% at this point so far. What does that indicate for the remainder of the year going into November?
Historically, when we've seen 5 straight months of gains, and obviously April was down, that usually is very, very good heading in for the balance of the year. The average gain is about 16% starting in, April into the end of the year, and April was down 4%. So that usually is very good. But, we still have two wars. There's a lot of contentiousness, a lot of, the climate is very poor right now in terms of being an election year. People are very unhappy, and, in general, that type of negativity is very, very good for the market. So sentiment has contracted. We saw those 3 weeks of decline in the market from late March into April caused, a lot of the polls to get almost neutral from pretty bullish levels. But I would argue that there's a lot of people still on the sidelines. A lot of institutions are not, going, fully into the market simply because tech hasn't really been working that well. But there's really a lot of other parts of the market that are doing well.
We had someone on yesterday saying that a lot of the gains are in the Magnificent Seven. We've heard that a lot, and that was one of the reasons that maybe this is questionable. You just said the breadth is much better. When did the breadth start improving, and what gives you that? What's the metric underneath that?
Well, the breadth started to be good at the tail end of last year. I mean, when we saw the rally from October into the end of the year, we saw a pretty broad-based rally, and it's much, much different heading into 2024 than it was, of course, heading into last year. And so we see, a lot greater stocks above their longer moving averages. So that's when I say breadth, I say, when you see more than 3/4 of the market above their longer term 200-day moving averages, that's normally a pretty good sign for the market. And so it doesn't, yes, having technology participate is important, but, when it doesn't, to see other groups like financials, healthcare, obviously has been a little bit of a laggard. And now that's starting to show some minor evidence of bottoming out. So, there's certain metrics that you can measure breadth when you look at advanced declines and this and that, but we're just looking at longer term gauges of how to look at the market.
And do you use some technicals on the 10-year? What is that indicating to you?
Yeah, a lot of the cycles I look at suggest that the yields are going to start to pull back pretty dramatically between now and August. So the next few months, I suspect that yields can get down well under 4%. Which would be a surprise to many people, but I think that also means that, maybe this recent trend of economic softening might continue. And so we'll see. To me, it doesn't matter how many cuts there are. A lot of that's irrelevant, but it is, the 10-year, if it gets under 4.35, and right now we're around 4.45, 4.50. So we're getting very, very close to a time when yields are really going to start to pull back a lot more sharply. And the dollar should follow suit. So it's going to be a good time for emerging markets. We've seen some initial signs of China starting to bottom and rally up those lows. And, honestly, I'm very optimistic over the next 6 months. This won't always be the case, but potentially into next year. But I think for now, I'm very bullish this year. I think we're in a sweet spot. Small caps and mid caps have started to make a little bit of progress off their lows. It's going to take a bit for those to really, participate to the extent that I think we would all like, but it's a moving in the right direction.
So when I heard that clip on CNBC last night, I was like, you guys have to hear that, because they sound a lot more conservative maybe than they otherwise would have. Of course, Mark Newton, he's still bullish. Fundstrat tends to be bullish over the long term, even when the markets are terrible, or, in 2022, they were very, very bullish as well. But it sounded a lot different. Fundstrat finally is acknowledging the weakness that you're seeing out in the economy. Here's the deal with weakness in the economy. It's never going to be bullish for markets. Let me tell you why. Because a weaker economy means lower corporate earnings, which means lower EPS, which means, well, that sucks for markets and valuations. Now, one could make the argument getting back to some form of trend in the economy could be good news. Maybe lowering consumer appetites for spending money could be good, because inflation really is derived from people's willingness to spend money. If people are unwilling to spend money anymore and spend money on higher priced items, companies, well, it's been a long time since we've seen inflation, so maybe, who knows, this time's different, but companies, they don't tend to raise prices anymore. You could make an argument that maybe prices could start to be cut in different areas of our economy. So the economy getting back to a pre-pandemic trend could actually be okay for the markets. But if the consumer, which is about 74% of the economy, starts to really give up in any kind of meaningful way, that's where things turn south quickly for stocks. Especially if you do start to see the odds of a recession rise. Judging off of where the Nasdaq and the S&P currently are, the markets are assigning a 0% chance of a recession within the next 12 months. I think a more realistic view is like a 50% chance of a recession. Now, back in 2022, the odds down here were a 100% chance of a recession within the next 12 months. That is why if you look at the Nasdaq here, the Nasdaq declined from peak to trough around 37.5%. That was a 100% chance of a recession. And I'm sure if we actually had entered a recession, maybe we could have fallen further. But judging off of just this simple math here, I mean, you could be looking at a 17, 18% decline just if we go to a 50% chance of a recession. And that's just, I know that's very crude math, okay? That would put you back to basically where you were October, November of 2023, which, not a huge deal in the grand scope of things. That's far off your 2022 lows. But that's just if the odds of a recession rise from 0% to 50%. And the sell-off could be larger. Who knows? It'll depend on earnings, what companies are saying, the data coming out, and projected EPS for 2025. But I struggle trying to find the bullish catalyst when expectations are already so high for EPS and for corporate earnings, and when expectations are at 0 for a recession within the next 12 months. I struggle trying to figure out the next catalyst here. Now, if the economy continues to be red hot and strong, inflation's probably going to be higher because, again, inflation, the core root of inflation is consumer spending behaviors. Now, based on polls I have run on this channel, it looks like about 50 to 60% of you guys are cutting back. You think the economy's bad. And you guys are investors, okay? Which I think this needs to be put into context as well. You're already ahead of the average US family if you're watching this video right now, no matter how much money you have in the bank or no matter how much money you have in your portfolio. You have a portfolio. A lot of people don't. If you don't have a portfolio, if you're not investing actively in the markets, you probably feel even worse about the economy if you don't have any savings or, again, a portfolio or anything. So I think 50, 60% of you guys that are cutting back, according to my polls and surveys, it's probably like 70, 80% plus of average household. I think that is not being appreciated by the markets right now. So there's a couple different earnings this week that I think could be quote unquote smoking guns for the consumer. And depending on what these companies say, it may change the way that I'm looking at the markets for better or for worse. And a couple different companies here. Number one is Home Depot. Now, I think this one's less important because this is obviously focused around homes and construction, things of that nature. We already know construction is not in the greatest place. We already know people are not rushing out to go do, DIY home projects, right? That's not first of mind for people that are struggling. So I don't really think Home Depot is going to be too important, just judging the overall consumer. On the other hand, Walmart Thursday pre-market is the smoking gun. Back in 2007, back on August 15th, 2007, this article was put out by Bloomberg. It says the implications of Walmart's warning. The retail giant lowered its profit forecast for the rest of 2007 in part because of the rising economic pressures on consumers. It says here, on August 14th, Walmart stores provided a bleak outlook for the second half of the year, even as it reported record sales and profits. Yikes. That's not good. They cited rising interest rates and gas prices that took a toll on paychecks. These days, it's not so much gas at the pumps. Obviously, that's expensive and it fluctuates day by day. But these days, there's pressure on paychecks from everything, from car insurance, from rents, from food. You ever try to feed yourself and your family at the grocery store? Holy guacamole, it's expensive. All of these things, I think, are bigger pressures on the consumer than even what you've seen back in 2007. Like, this is bad. And you can sit there and say, yeah, well, wages are catching up, blah, blah, blah. They're not. Let's be honest. Wages have nowhere close to have caught up or kept pace with inflation. Now, let me just put this into a little bit of perspective and just how bad the inflation has been. So, I had my first child on August 31st, 2020. So before the inflationary pressures really started to pick up. And I have picture proof showing that a can of formula, this kind of formula, was $19.99 in the stores. Okay. Today, what you get for $20 is this. This can has 12.4 ounces of powder formula in it. This can has 30.8 ounces. That is more than a 100% inflation in formula in 4 years. And I should say my son was born on May 20th, 2023. So just a 3-year difference, 4-year difference has done this. Wages have not caught up with this. And he goes through this like every 2.5 days. Now, Walmart stock is sitting close to all-time highs. There may or may not be a trade for Walmart's earnings. Maybe, but I just want to know what Walmart has to say about the consumer. In fact, take a look at what happened on August 14th, 2007. The S&P was down 1.53%. The next day fell 1.38%. The next day hit a short-term bottom. You rallied until the Fed chairs warned Congress in October, early October, about a coming economic slowdown. And then what happened? Stocks went down the toilet. So it took some time after McDonald's did give this warning about the consumer, or Walmart gave this warning about the consumer. McDonald's has warned about the consumer now for the last 2 quarters, but they were eventually proven correct. And there was a slowdown and thus a recession. And let's just be honest, if Walmart says anything negative about the consumer, in which they did back in 2007, lowers guidance, whatever the case is, I think that could be a moment the markets start to wake up to what is actually happening out in the economy. And that could actually be a huge catalyst for broad markets. In fact, take a look at what happened on August 14th, 2007. The S&P was down 1.53%. The next day fell 1.38%. The next day hit a short-term bottom. You rallied until the Fed chairs warned Congress in October, early October, about a coming economic slowdown. And then what happened? Stocks went down the toilet. So it took some time after McDonald's did give this warning about the consumer, or Walmart gave this warning about the consumer. McDonald's has warned about the consumer now for the last 2 quarters, but they were eventually proven correct. And there was a slowdown and thus a recession. Now, coming this week, as far as economic data, we are going to have Fed Jefferson and Fed Mester at 9 o'clock in the morning coming tomorrow. Fed Mester, just Loretta Mester, tends to be very, hawkish anyways. So, we'll see if the markets pay attention to that. These days, markets don't pay attention too much to Fed speakers. And I think the Fed is just way behind the ball as it is. But at 11 o'clock in the morning tomorrow, you are going to get consumer inflation expectations as well. Expected to come in at about 3.1%. So that could be an important one coming out tomorrow. Tuesday, you're going to get PPI month over month, expecting that to come in at 0.2%. I think PPI is probably going to come in lower than that. I think the data is now starting to catch up to the consumer's spending behaviors that are definitely slowing down. So I actually think the pressure on inflation rising is probably going to go away. Also worth mentioning is oil last month went from $83 a barrel down to the end of April. You were sitting at about $77 a barrel. So that's quite a decline for a 1 month period, and that probably gets reflected in for sure PPI, but we'll see about CPI as well. That's about a 7% decline in the price of oil, which oil is one of the biggest input costs to any company there is, because it affects transportation, right? Any company is gonna, transport their products somewhere. So that is definitely something I'll be watching for. But again, I'm not worried about inflation right now. I'm more worried about coming deflation in the economy, believe that or not. Jerome Powell will speak at 10 o'clock in the morning on Tuesday. We'll see if he takes a dovish, maybe cautionary stance on the economy. If he does, that's going to be another big heads up for what's going to be coming out on Wednesday, because on Wednesday you will get the CPI numbers. The big number to watch is core month over month. You're expecting 0.3%. Last month you came in at 0.4%. I think this could actually surprise to the downside around 0.2%. Now keep in mind, the number that you'll see over here on Trading Economics or on CNBC is going to come in at 0.3 or 0.2, but it's down to the actual decimal point. So they round these numbers. So if you come in at 0.24, you're going to get round down to 0.2. If you come in at 0.34, you're going to get rounded down to 0.3. If you come in at 0.35, you're going to get rounded up to 0.4. So you really want to see what the actual decimal point, the actual number itself comes in as, because you could be on the high side of expectations or the low side of expectations and still get a 0.3% number. But a 0.25% number rounded up to 3 is going to be a lot better for markets than a 0.34 number rounded down to 3. Hopefully that makes some sense. There can be half of 1 point rounding that takes place here. So rounded, down, not great. Well, better, okay? Rounded up, not going to be as good. Okay, so keep that in mind. Retail sales month over month are also expected at 0.3%. Last month you came in at 0.7%. I think this could also miss pretty big, and markets may initially take a slowdown in the economy as good news, right? That's definitely a possibility. And that's why I want to see what Walmart has to say. And again, I'm not expecting any kind of huge recession fears to really start this week. It's possible, but I think it's going to take another month or two before the markets realize, markets are a slow moving beast, that we're probably heading into a recession here. So, just again, keep that in mind. Now, on Wednesday, for what it's worth, we're going to have Fed Kashkari that speaks at noon. I say for what it's worth because you're going to have Powell, CPI, retail sales, all of that before Wednesday. That's probably going to be the thing that moves the market. So I don't think any Fed speakers following Jerome Powell is going to be that big of a deal. Now, on Thursday, you will get building permits preliminary numbers for April. The higher, the better. More permits, more potential building, less housing inflation. That's the logic out there, right? Initial jobless claims last week came in about 17,000 higher than expectations, and that's something to be watching for coming Thursday. Expecting a number of, let's see, about 225,000. If that comes in higher again, initial jobless claims seen as a leading indicator to the employment market, and again, something that maybe the Fed already has the data on, and that's why I want to see if Jerome Powell is dovish, if he's taking a hawkish approach, if he's talking about cutting rates sooner. We'll have to see, and I expect this week's going to be a pretty big week for bond markets and, well, 10-year treasury yields, to put it frank for you. Now, Friday, there's not going to be too much. There is going to be the CB leading index month over month. That will come out at 10 o'clock in the morning. Fed Waller also speaks at 10:15 in the morning. So given all of this incoming data for this week, I'm actually pretty bullish for this week, and I'll tell you why. I think the economy weakening, the markets are still under the impression that that's good news. Again, that's never going to be good when the economy is weakening. That puts pressure on corporate earnings, and that puts pressure on valuations. That's never going to be good. But if inflation does come in lower than expected on Wednesday and Powell takes a dovish stance on monetary policy and hopefully doesn't caution too much about the economy or consumer on Tuesday, I think at least from Monday through Thursday could be pretty good for markets. Now, Thursday is going to be a bigger test with Walmart. If Walmart has negative things to say about the consumer, well, that could be a warning sign that the markets pick up on that says, hey, this economy that's 74% dependent on consumers spending money, it's in trouble now. And that's a possibility for Thursday. So there's going to be a lot of volatility this week, but I can see a path forward that's probably more positive for equities than not. Now, the next 2 to 3 months, I think recession odds are going to rise. I think that puts pressure on stocks. That's the simplest way to put it. I think by July 31st, that Fed meeting, you're going to start seeing some rate cuts. Depending on if the economy weakens fast or slow, that's going to dictate just how many rate cuts. And I could come to the conclusion that maybe by July or September, given it is an election year and the government's going to do whatever they have to do to avoid a recession, you could be seeing 50 basis point rate cuts by July. That's about 12 weeks from now. So I think the next month or two could get pretty wild for stocks. Stay tuned to the channel for all of your updates each and every single day that get posted at 4 p.m. I think we are very early in identifying this upcoming slowdown in the consumer, possible recession. And if you're watching this video, you have a huge heads up ahead of really big money. Now, I will also tell you that the Dow is coming off of a very strong last 8 days or so, whereas the NASDAQ and the Russell haven't been doing nearly as well. That's also a sign that investors are getting somewhat worried about the state of the markets and the economy. When the Dow outperforms and people are switching to defensives and healthcare and really your blue chip of blue chip companies, that's not necessarily a good sign for risk on assets, the economy, or markets either. So there are some warning signs out there, but I think the markets are getting to a tipping point, and we'll see what happens. This week will be vitally important for just that. Hit the like button and subscribe to the channel if you made it to the end of this video. Most importantly, though, enjoy the rest of your day. Enjoy your Mother's Day, and if the 10% or so of you guys are females and mothers out there, according to YouTube analytics, about 10% of you guys are females, well, happy Mother's Day. And if you're a male and you have a female in your life that is a mother, I suggest you get some flowers. Okay, that's just a simple one. Get some flowers delivered and make their day a little brighter and smellier. That's literally all I can smell all day are those dang flowers. And honestly, I'm not disappointed. They smell pretty good. Nonetheless, thank you for watching. Enjoy the rest of your day, and I will see you in the next one.